Hi, welcome everyone to another CIO webinar series. I've been doing this for 11 series now, and I hope this will be helpful to you and your clients in terms of understanding what's going on with the market and how to position yourself. Today, as promised, we have a special guest from Santa Lucia Asset Management, Florian Weidinger. Florian, you there? Hello? Okay.
Good evening.
Hi, good evening. Thanks for joining us. And this is also the first time we have a guest speaker on the series, and we hope to bring more industry professionals and managers to this talk. And along with me in Hong Kong is also Hian. He's also a partner at Santa Lucia Asset Management, happened to be here for what, Hong Kong earnings, right?
Yes.
Okay, so you can tell us more about that later, whether you like it or not. Okay, so before we have a discussion with Florian and Hian, that just a quick recap on our house views. I've been saying that focus on the Fed trade, not the carry trade. Don't try to overanalyze this Japanese yen carry trade. Even as a hedge fund manager myself before, I found it very difficult to understand the true picture of how much is at stake here. But we do know that the fundamentals of artificial intelligence remain strong. That has not changed. And that will not be changed by the carry trade or whether Trump or Harris win the president. We have very strong conviction on that. The other thing we know that is since August this year, the market begins to worry about the US economy, and we are very vigilant about this. And because of that, the consumption will be a key thing to watch for the US economy and the stock market going forward. We really need to pay attention to the health of the US economy and the consumption. And there's some traits here I keep talking about over the last few weeks. I'm not going to repeat it. Whether it's the rate cut trade or whether it's AI or something like consumer staples. And also we've been recommending gold since the beginning of this year. If you've been following our advice, you should do very well with all of these investments, including gold. China, okay, this is also it's a very tricky topic. We said recently that we're getting incrementally negative on China and more cautious on China because we have continuing macro uncertainty and policy disappointment forming the so-called new normal. There's one slight hope that the current earnings season in Hong Kong may offer some optimism. We have better than expected numbers out of Tencent, better than expected numbers out of JD and a few other companies. And the market has held up. So that will hopefully give us some optimism during the earnings season right now. But longer term, we are still very cautious. And under this new normal, I talk about 5 reasons why you should shift your portfolio to Chinese SOEs, and especially central SOEs. We also talked about this last time. I won't go through it again. And there's some core recommendations here. And this is exactly what we're going to talk about. Today, the focus will be for me to discuss with Florian, a very successful portfolio manager with over 20 years of experience investing in emerging markets, Asia, and China. He's the CEO of Santa Lucia Asset Management with AUM about 1 billion. And previously, he was also the CEO and the CIO of Hian company in specializing activists and special situations. So without further ado, let me turn to Florian to first give him, give a personal intro as well as introduction to the company.
Thank you so much for this. Thank you so much for this nice welcome.
Yep.
We at with SLAM, we are a boutique firm, employee owned. There's myself, but there are also over 20 other team members across locations in Singapore, where we're headquartered and regulated, but we also have research offices in Jakarta and Taipei, and we have 2 middle office colleagues who are based in London. We manage just over $1 billion for a range of investor types. We have really the full range of big institutions, medium-sized institutions, family offices, high net worth investors, and we also serve a sovereign wealth fund. We have, I think, I can continue speaking, but I think the slides were lost in the process from your side.
Should we share the slides?
Yeah, can you share your screen now?
No, we're using the same slide.
Same slide?
Yeah.
Okay. Can you?
Yeah. Can you put it back to this full screen?
Okay. This is
same slide. There's no separate slide.
Okay. Who's my? Okay.
The old slide before.
Sorry.
Yep. Sorry about the hiccup. Okay. So go ahead, please. For it.
And we and one of the reasons why we have a fairly sizable team of over 20 professionals, over half of whom are investment professionals, each with a significant amount of experience and a lot of local language knowledge, local networks, as we place a lot of value on direct company contact. Our investment style for our strategy is very focused on having a lot of meetings throughout the year with all of our companies. We have over 700, 800 meetings every year, and sometimes we meet the same company over 10 times as the year progresses. We meet them sometimes when they pass through Singapore, maybe to visit their bank account. We meet them when in their home turf, wherever that may be across Asia. We meet them at conferences. We talk to them over the phone. Whatever the medium is, direct company contact is really what drives our investment process. And the reason we place so much emphasis on this direct company contact is that the core sort of question we ask ourselves investing in this region, and please forgive me, I appreciate it. I'm the European who's moved with his life and family to Asia, so I feel always a bit silly talking to Asia and about Asia in third person. But when looking at Asia and at the Asian investment opportunity, it's one of the things that stands out is that what can really be very detrimental to your investment is usually a conflict between the minority investor and what the controlling shareholder wants. Most companies in Asia are controlled by somebody else. It can be a family, it can be a government with the SOEs. It could even be a multinational, Nestle Malaysia, Siemens India. Those are all companies listed in Asia but controlled by a foreign corporation. And the truth is there can be a conflict with the majority owner under all three circumstances. Even Unilever, an ESG champion supposedly from Europe, has misbehaved greatly with minority investors here in Asia. And so it's just inherent in the relationship of a weaker minority coexisting alongside a dominant shareholder. So our key research question is, how can we, as an investor who holds a minority stake in a public company, how can we coexist and earn a return alongside the majority owner? And for that, understanding their intentions, what do they want out of the company, and do they want the share price to go up? Do they want to use the company to create value, or are they using the cash flow to divert to other means? And that's why our strategy focuses also a lot on dividends. For us, dividends are a very important marker of this alignment of interest, because a company board that has to decide at least once a year, ideally more, 2 or 4 times a year, but at least once a year, if it's a dividend paying company, they have to decide how much of the cash do I pay to my cousin in a related party contract, and how much of the cash do I pay to all shareholders pro rata to their ownership. And that's why we believe focusing in Asia on companies that pay a dividend, we have a couple of pieces of evidence. We have evidence that there is cash flow. We have evidence that there is therefore an ability to pay, evidence there's a willingness to pay. And we typically, if we're investing at a high dividend yield, and in our strategy, we're targeting a 6% target yield for the entire strategy, which can be paid out of the strategy, and then also a capital gain to at least initially underwrite an individual position to deliver a sort of a mid-teens return, that we also have typically evidence of a position being somewhat undervalued when we're searching for stocks in fulfillment of that 6% target. And what tends to happen is that we then get paid, hopefully paid while we wait. So the idea is that we invest in undervalued companies that are dislocated for a reason. Maybe the market is not fully appreciating how the future might be a bit different from the past. And the market, there's something that Mr. Market feels uncomfortable. You might remember Mr. Market from Ben Graham's book, The Intelligent Investor. If Mr. Market is unhappy about something, a stock may trade temporarily at an 8% or so dividend yield. And our strategy is to buy these companies that are temporarily undervalued, understand whether we can find temporary alignment with a majority owner, and we then have to, of course, wait, like all of us investors do, for an outcome. But the good news with a dividend strategy is that we get paid while we wait. And so while we're realizing a reasonable total return over the investment period in our strategy, we also have the benefit of getting paid. Part of the total return gets paid to us as we hold. And that's what protects the strategy from investing in what are often known as value traps in Asia. We are an unashamed value investor. We really believe that margin of safety, how you, at the entry point that you choose to invest in valuation, is key alongside the alignment of interest. But it's also important for there to be a dividend so that you are protected from your own illusions as an investor of what might be a cheap company, because the proof is in the pudding, the proof is in the cash flow. And so we often find ourselves in the strategy identifying cheap companies where we find alignment with a majority owner. While we are trying to understand the company, while we're working sometimes with the owner, that's another important plank of the strategy. Sometimes we're waiting for change, and we have, as a firm, been able to successfully convince owners to do things that help the value realization. We have successfully gotten owners to change their their dividend distribution policy, their capital policy, to buy back debt. We've gotten owners to change disclosure. We've gotten controlling shareholders to consider divesting assets into a REIT for better capital recycling. So our dialogue is there to sometimes shorten that time period while we're waiting. But the key point is we're investing in cheap companies and we're getting paid while we're waiting to realize a catalyst.
Great. And here's some basic information on the strategy, including the country, the sector classification, the top positions. And we're planning on time to dive in further into a strategy and some stocks. We also prepare some case studies later. So before we talk in more further details about what you do and how you do this, first of all, we understand you're not a dedicated China manager, but based on this composition, look like you have almost 50% invested in Hong Kong, China, which is great. In this environment, it's really hard to find a foreign asset manager, still find China investable and interesting. There's one question I think all of us on this call will be very interested in to find out is, what are your clients, not you, but your clients being the big money globally? We talk about your institutional investor base, family offices, sovereign wealth funds, insurance companies, and look like what, 85% is from Europe and slightly over 10% is from US from our prior conversation. We will be very interested in knowing what they are thinking about China right now. I know you have a constant dialogue with them on that.
Yeah, I mean, our investors are mostly from Europe and the US, and it's fair to say that even though we have been able to deliver a decent absolute and relative return over the last few years, we're constantly on the back foot in conversations with our clients, because most clients react very nervously. We're Pan-Asian investors. We have stocks in Kazakhstan, in Pakistan, in India, in Thailand, in Indonesia. We really invest across Asia, but you're absolutely right. We find the greatest opportunity at the moment actually in high-yielding dividend stocks in Hong Kong and mainland China. And a lot of our investors are very nervous about this, as the allocators who allocate to funds have a very hard time in their investment committees to defend an allocation to our fund, even though we have sort of delivered on the performance element. They're in admittedly a tough market in Asia and China. They're very nervous about the China piece.
Either, right? You just have China exposure. Just imagine how difficult a time it would be a dedicated China fund will have convincing the investment committee of their clients.
Well, to tell you an anecdote, so we used to have a US distributor. The emphasis is on the verb used. Our US distributor closed because they lost over 2/3, over 70% of their so-called assets under advice, because they specialized in bringing Asian, largely China-centric managers to the US. That's how bad it is. And I think the trouble is that too many people seem to suspend their otherwise very professional judgment on all matters investment, volatility and positioning, and everybody's so sophisticated. But when it comes to China, sadly, all that sophistication seems to go out the window, and people are not even willing to entertain the conversation. We have one insurance client from Germany who told us we're there. They used to have 6 or 7 Asia managers. We're their last. They cut 6 out of 7 Asia managers, and that's a big insurance company from Germany. So
you must be very well in order to maintain that status among those anti-China investors.
Yes, that's well. We do have to answer that question about every 2 months. We write a monthly letter where we try to put out information. But I think the real challenge is that, and I think that's something that also global investors might need to develop a better perspective. That we actually don't think that it's worthwhile to wait for the Western investors to buy again. They have had lots of grandstanding, and of course, talk is cheap. While China is not performing, it's very easy to say China is uninvestable. My personal thesis is that at some point this will change. When China starts performing, people will maybe jump again on the bandwagon, but it can't happen now because it's too recent that people have done this grandstanding and say, oh, China is uninvestable. And it's very hard to climb back down from that great talk. So we actually think that the marginal buyer of Chinese and Hong Kong equities are actually the mainland Chinese themselves through the Southbound Connect, which has had positive flow for literally every calendar week this year. And other pockets of the world that have significant capital that's looking for a home that is a bit less troubled by, let's say, the geopolitical and financial news cycle of things. And we traveled through the Middle East earlier this year, and we actually got a very good reception from investors who are very keen to understand, oh, there's this part of the world where you have a massive divergence in very high earnings yields or low PE ratios, very high dividend yields, but actually a very low cost of funding, right? So the average Chinese company can fund at 4% if they are a functioning company, especially the SOEs. They can fund it at even less than 4%, and they can buy back shares or at typically PEs of less than 10. So that becomes a very compelling, and our net cash and dividend paying. So that becomes a very compelling investment thesis if you're not so troubled by what you read in, let's say, the Financial Times or the Wall Street Journal every day.
Yeah. And so basically, you're saying that investors really need to look at the numbers, not be easily fooled by the headlines, which is very biased, maybe.
Yeah, ultimately,
as a source of new capital, any particular reason why Middle East now is? Well, you talk about the geopolitical reason, but is any other reason, such as?
Well, I think there's a deeper reason. I think we see of course, closer political cooperation of China and the Middle East. I mean, we've also seen the expansion and more friendly version of the BRICS that is, and Chinese companies are opening commercially to the Middle East as well. When I was last in Riyadh in January, the hotel lobbies were full of Chinese businessmen, and several of our portfolio companies have actually done reasonably well increasing their revenues from the Middle East or other, let's call them third countries, or in the 70s they used to be called the non-aligned countries, so Middle East, South America, Africa, and so on. Those regions seem to be places where Chinese corporates are successful, and as corporate links increase, as political links increase, it's very natural for other capital links to also come. Now, it happens to be among the countries mentioned, the Middle East is the place that has the money, so that's why that's the flow that seems to be getting a bit more interesting to watch.
Yeah. Okay, let's switch gear a little bit. Well, in terms of macro view, we actually I had a really interesting discussion with you earlier about the macro view. You were saying that, the macro picture may not also be as bad as what the media portrays, and the global perception of this deep crisis may be overstated, and there's also some positives in China in terms of the high savings. I want to connect that view to your view on the Chinese SOEs, because also from our last discussion, you talk a lot about the Chinese SOEs, and we also like Chinese SOEs. So that's why part of the reason I invited you, try to hammer this out, and try to see where we can agree, where we cannot agree. So please go ahead to talk about, your China position right now in your portfolio and your Chinese SOE's views.
Yeah, so this is a view that we've been writing about in our monthly letters for a couple of years now. And also the way that our portfolio is positioned, we have been holding quite consistently over the last 3 years, over 60% of our, roughly half of the portfolio that's invested in China is invested in either SOEs or hybrid SOE firms. We agree with you that you need to be very discerning, and it's the central SOEs that are where what I'm going to go into seems to be working best. The below are extracts from a presentation I gave at a value conference in Italy last year, and where my somewhat radical view here is that Chinese SOEs have turned from being sort of the uninvestable part of the Asian investment universe to maybe the most investable Asian stocks today, and which of course makes every European and American usually shudder when I talk to them about this. And we all used to avoid SOEs, but the shift to SOEs is also very symptomatic of our strategy. Our strategy routinely finds the pockets of the market that are unloved by searching for a high dividend yield, a high dividend yield being an expression of undervaluation. And these companies, of course, used to be cheap for a reason. SOEs used to be capital destroyers that trade at 2 times earnings. And that was the right price for a company that was pursuing the interests of the state. But 3-4 years ago, something dramatic has changed. That's the point when China started approving about 35 new share option schemes every year. Before it was 4 or 5 every year. And starting in about 2021, suddenly many share option schemes got approved. And so that changed the nature of SOEs. Why? Because at least our interpretation, and we're just a student of this, we don't know for certain, but our sort of student's conclusion here is that the Chinese leadership has decided that because it coincided with the clampdown on the private sector, that China needs strong firms to pursue its strategic goals, but Xi Jinping doesn't want these strong firms to be in the hands of Jack Ma and other sort of people that can gain political power, and therefore the SOEs need to become strong and capital efficient. The SOEs become capital efficient by having management teams that are incentivized to do the right thing. That's why you have over 100 central SOEs now where the management holds share option schemes. Some of the examples that I can maybe get into later, we have several layers of management teams, sometimes the top 200-300 employees are equipped with share options. And you remember, as value investors, we remember Charlie Munger, show me the incentive and I show you the outcome. And so you have a management team that's incentivized to deliver. And it combines very powerfully with something that's still fairly new. As of the 1st of January 2023, return on equity became a KPI for the assessment of the individuals running SOEs or being in charge of SOEs within the Communist Party and in board structures. And so if you want to make a career, you now have to show that you can improve the ROE of the thing that you're in charge. And so previously a party member would want to already think about their promotion to becoming lieutenant governor or deputy mayor somewhere else in 3 years' time. Now they actually need to deliver on a job. And we had another reform in 1st of January 2024. They added another KPI, which they call shareholder value management, which is essentially show me what you're doing to improve the share price. So we have these ugly ducklings of the capital market that are trading at 2-3 times PE, that are suddenly getting share options, a target for capital efficiency, a higher return on equity, and what have you lately done to improve the share price? And that makes these companies just too cheap to ignore, but also priced for a wrong reality. They are priced for the ugly duckling. They're not priced for the share option schemes. And that's essentially what our strategy does. We lean into what investors might be missing, and we accompany companies along this change. We've even connected SOEs to each other to help learn how to apply for a share option scheme. We've done that too. This is a very long journey. It's going to take multiple years. We're sort of 2-3 years in, but we expect it's going to be a continuous source of ideas for our strategy and how we're positioned. And the proof, frankly, is in the pudding. SOEs that have adopted those elements of reform, for example, the share option schemes, have started to outperform the broader equity market.
Can totally see that. And this is also entirely consistent with what you described earlier about your Asia, your overall strategy on corporate governance, on dividend payout, dividend yield, and also engagement, right? And just to be clear, this SOE thing, I agree with most of what you said. But my understanding also, not every SOE is going through this type of positive transformation, and not every SOE can be engaged easily. That's why employing a manager like you is critically important for stock picking, right? So we can't just blindly buy a basket of central SOEs and expect them to outperform. I think there's be a lot of work in terms of what you just described. First of all, we need to do the bottom-up work to identify those companies, and then there's also a bit of engagement. So in the spirit of that, can we talk about some case studies? I know you sent me some. You sent me a lot more. I just handpicked a two. I think kind of most representative of your philosophy. So please fire away.
Yeah, just to briefly touch on that comment. So you're absolutely right that stock picking remains essential. One of our key learnings, and we were in Beijing just 2 months ago, meeting with one of the government officials in charge of the SOE reform package. And he sort of admitted to us over lunch something that we had suspected, but I now know for certain, that the Ministry of Finance linked SOEs seem to work on a slower calendar here. So the pace of reform in Ministry and MOF SOEs seems to be slower than some of the other central SOEs. And so the stock picking and talking to the company remains very important. It's a great pond to fish, but stock picking remains very important. Yes, so China State Construction is probably a beautiful example of, I mean, the name alone would normally make it uninvestable in the eyes of a lot of European investors, I think. But it really struck our attention when they had, the chart that's on the bottom right. That's an extract from their PowerPoint. So this is a state-owned enterprise that's showing on page 4 of their investor presentation. An ROE improvement path, and how are they currently doing against that long-term ROE improvement part? I mean, that's remarkable. I wish every Asian company would do that, but here is a central Chinese SOE doing that. And what's also remarkable is this company, which is, a sector leader. It's a leading construction company active in China and Hong Kong. They're actually probably the leading sort of leader in R&D to do modular construction methods, so to basically bring the house half ready to the site, which reduces pollution and over long time reduces energy use. Can also build houses faster that way. It sort of looks like this is the future. So SOEs need not be stale. SOEs can actually be leading edge as well, and this is what, again, she wants out of the SOEs. That's why this is happening. There is supposed to be dynamism in these companies, but it's a very cheap company. It's trading at just over 5 times PE and a 5.3% dividend yield. And
this way, you want to say something?
No,
okay.
I'm just saying that actually, and you'll find that as some of these SOEs here, they themselves drive and implement such changes, and they are getting the results. And over course of us meeting them in the results seasons, they themselves get more excited.
Yeah.
And the more they want to share and implement such changes.
I noticed that. Yes, the state-owned companies are much more open now in general and transparent. And let's hold that thought, Florian. I'll challenge you later on this China State Construction. But what about the second case, Sinotrans? Also, to me, it's a very boring and low growth company, but you seem to like it a lot.
Yeah, we do actually, because we actually think Sinotrans is probably sort of the best kid in the class when it comes to SOE reform. They have been a very early adopter of share option schemes and the ROE targets, and that company has really changed the way they operate. You can see it in their last 2 years or so of quarterly reports, how this company is really thinking very hard about capital usage and thinking about which parts of the value chain do I want to be in. And they have been gradually shifting the business towards the more asset-light parts of the value chain in the industry. They have actually let go of some businesses or let go of some contracts that were not capital efficient for the company. So the ROE target has had a real impact in the way the management runs the business. So it's not just a nice story to tell. It's actually translating into real changes in how the business is run. That's also the company that is actively working on a spin-off of assets into a REIT. We've had many discussions with them on this. So it's also, to your point, a nice example of you can actually talk to these companies and you can actually have a dialogue, and the dialogue can lead somewhere. And valuation-wise, it's just tremendously cheap. Trading at less than 6 times PE, trading at a dividend yield in excess of 8. So the dividend yield is higher than the PE. And if you don't believe us, maybe you should believe the mainland investors in Shanghai. Mainland investors in Shanghai routinely trade trade the A share at 1.5 times the valuation in Hong Kong. So people in Shanghai are willing to pay close to 10 times PE for this company. And the Hong Kong shares are trading at a significant discount. One, because H shares tend to trade at a discount to A for very structural, including tax reasons, but B, also because Hong Kong is the place where the foreigners have been selling like crazy. And so this is a very nice example also where we have that H to A convergence over time, and this management team really sort of gets it and has really also now delivered commercially.
Okay, let's stop there for now. I'll also challenge you later on the Sinotrans. I have a couple of questions, but to be fair, I do want to open the floor for Q&A related to what's being talked about today, the SLAM's dividend strategy in Asia plus China, your focus on Chinese SOEs, and it's also our in-house view on Chinese SOEs and anything related to China. So if you have any question on that, please use the chat window to enter your question. We will answer them in the order they come in. So while we're waiting for the Q&A, I do want to go back to the China state construction. It is counterintuitive, Florian, that with such a poor real estate market, almost people say it's a crisis, real estate market crisis, you would invest in a construction company. How do we think about that? How do we try to reconcile that? Even though I understand it's a dividend paying, high quality, well-managed company, cash flow, etc.
Yeah, I think it's very much a question of what are they capable of delivering. So this is not a sort of commodity construction business. They do very specialized projects, for example, a lot of hospitals. They also have what they call technology-driven construction. So construction projects where their leadership, for example, in modular methods is very relevant, which is something that Hong Kong as an entity or as a territory is embracing. They also have significant exposure to the northern territories, where, as we all know, there's significant political will on both sides of the dotted border to make it work. And so you're absolutely right. We're very careful when it comes to sectors like steel, cement in China right now, and construction. But this is a company whose services are in demand because of their sort of high sophistication. And then a sort of a secret truth is well, maybe not the secret truth is, of course, that SOEs are favored in today's China. So today's China system is organizing in a way where SOEs get sort of first dibs in projects, and this company is no exception.
Okay, and then on Sinotrans, you talk about its international business, global expansion. Do you think the geopolitical risk will become a risk to the company when they do business outside of China?
Yeah, so Sinotrans is one of the examples.
Yeah.
Oh, sorry.
Go ahead.
Sorry, continue. No, I was going to say that Sinotrans would be an example of one of our companies that has an international business. We're actually quite domestic at the moment in China. We're very few, but those where we have a foreign footprint tend to have that footprint in what I earlier sort of referred to as the non-aligned countries or the third countries. So the Middle East, South America, and so on. And Sinotrans has expanded its warehouse footprint, for example, in the UAE. They also benefit significantly from China's increasing links with Southeast Asia. We have another portfolio company that's also a derivative of that. But when you talk about overseas and international trade, it always matters a little bit where, right? So intra-Asian trade can do well even when geopolitics is tough. Well, actually, sometimes it does really well when geopolitics is tough because of repositioning. Yes, this company is of course a little bit exposed to the overall, let's say, business cycle. So this is not a telecom company. This is a company exposed to the overall business cycle. But they actually tend to do better when it's a bit harder out there because they are a sector leader. They are Actually, half their business is DHL China. So this company is Deutsche Post's chosen joint venture partner to run DHL China. DHL China is actually half Deutsche Post from Germany and half Sinotrans. This is one of the few instances when the German language really came in handy in investing in Asia. But we really think this their business model is one that's of course sort of medium-term cyclical, but at the same time is positioned very differently from companies that sell 40% of their revenue to the US and Europe.
Yeah. Okay, so we already have a number of questions lined up, and if you will, I will start with the questions that most relevant to our webinar today, which is again on China. So one question is, are we suggesting a move away from private company like Alibaba, Tencent to more SOEs for dividend and capital gains? I guess the answer is yes. If you join our webinar, CIO Series 10, last month, I talked exactly the 5 reasons why you need to shift towards more SOEs. I will not say you have to put 100% of the China money into SOEs, but it needs to be more balanced at least. I think the previous philosophy of only, and the foreign also referred to that to a certain extent, right? People, whether in Europe or in the US or even Chinese investors, used to have an exceptionally strong preference for privately owned companies. And they will never ever touch SOE companies with a 10-foot pole. What we are saying is that there are real changes now happening with this sector, whether it be the state-owned enterprise reform, the leveraging, raising payout, overseas expansion, becoming more tech-oriented. All these changes will warrant your attention for you to build a more balanced portfolio. So again, in our core recommendation, now we have roughly half of our core recommendation for China state-owned companies, and we'll try to increase more. Foreign, any thinking on that? Do you intentionally avoid private companies? You don't, right?
No, I wouldn't say that. I mean, we still invest in private companies, but the Chinese government has been very clear. They now have a truce with the private sector. In the latest sort of Politburo readouts, you can read about the 2 stalwarts, they called them once, the state sector and the private sector, but it's always state sector first. There's a lot of lip service to both are important, but it's always SOE first, then private sector. And there are some great private sector companies, but this role of the SOEs has changed in China. And while we are generally skeptical of investing in state-owned companies, we remain very careful outside of China. This is one of the least understood changes in the global economy. The way that China views its SOE sector has changed as of 5 years ago. And that's real news. And as John Maynard Keynes, the great economist, said, when the facts change, I change my mind. And I think we all have to change our minds because the facts have changed. It's
a paradigm shift. And there's also a really good question on sectors. We did talk a lot about SOEs. I remember we talked about sectors, and you're kind of a sector agonistic, meaning that you don't really care too much about the sectors, but it's really a natural result of your stock picking. Am I right? So I remember we talked about consumptions. So one investor wants to know what are the promising sectors or Chinese sectors that can deliver upside in 2025.
Yeah, so we're definitely we're a bottom-up investor. We go where the opportunity is, and our dividend compass finds us the opportunities. We screen them, and then we end up wherever we end up. We of course risk manage a little bit to not have a too extreme tilt. At the moment, we don't own any financials in China because the banking sector seems to be a sector that the government is using to solve problems rather than a sector to create value. We like the sort of industrial sector in China, where there's a lot of industrial companies that are doing very well. Tiamkon just met in Hong Kong yesterday for lunch, one of our key holdings, China Hongqiao, who had great results. Aluminium company.
Aluminum, that's right. Yeah.
Aluminum company. Sinotrans is industrial business. China State Construction is industrial business. you mentioned consumption. We don't own a lot in consumption right now. We own a company called Bossideng, which has done quite well for us. As one of the sort of relative winners, consumption has been, of course, a dog, but there has been a shift in market shares, and people have been downgrading from shown for the first time probably in generations, a willingness to downgrade, a preference for local brands. And so there are still some relative winners. And we are actually looking at a lot of consumer companies right now. We didn't buy into them when the COVID rules came off. We didn't pile into that consumer trade, but we are increasing our research activity. We haven't yet invested the strategy in it, but we are increasing our research activity because some of the consumer companies are so unloved because everybody got disappointed in the last 2 years that some of them are now available at very interesting valuations. So we're looking, but we haven't deployed.
Consumer staples. A lot of consumer.
And then,
okay.
And then please do not switch off the audio and video when I say that, but we do still see some relative winners within the Chinese property sector. I know this is a completely toxic topic to many, but there are some relative winners. People are still buying homes in China today. It's down a lot, but there are still just under 1 billion square meters of homes being sold. And some people are buying property and some companies are selling. And that's also an SOE story where SOE developers are gaining market share from the private sector developers. In fact, their market share has now overtaken the market share of private sector developers. And the same goes for the property management companies. Some of them have very viable business models, pay excellent dividends, and have net cash balance sheets. So I'm not advocating to put and we don't have a lot of the strategy in it, but we have a little bit in it. A sort of small, low single-digit percentage is in what we think are the survivors and the long-term market share winners in a very unloved sector, toxic sector, but some of these companies are generating great cash and pay dividends, and they're gaining market share because so many of their peers are essentially bankrupt.
Yes, it's a consolidation story. And I think one investor or one participant just want to echo what you said about the dividend yield strategy. He said he bought Bank of China and at a good price. Nowadays, he not only collecting the dividend, but also enjoying the capital gains. Good for you, Ken, whoever presented this message. Thank you. Thank you for sharing. And we have a lot more questions lined up, so try to keep each answer relatively short. There's a question again, if you can expand a little bit on the China State, the construction's technology, construction. Is it data center? Is it AI related? Or what do you mean by technology?
I mean, this is more of a reference to construction methods as well, right? So
the construction technology.
They are
not the. Okay, I see.
Yeah.
Got it. Stock 3311.
Yeah, it's the same one.
So how would that be possibly impacted by all the issues surrounding real estate? I think we already touched this topic. What is the real estate exposure? Approximately.
I think we have less than 5% of NAV in China real estate at the moment. We used to have a bit more, but actually one of our holdings just got bought last month away from us. We were hoping for more upside, but it got bought at a big premium, but we were hoping for more over multiple years. But there are some relative winners in the sector.
If I may add, one possible winner in the Chinese property sector is the Chinese property servicing companies, because what happens is that they actually still have a lot of things to do, that they have to provide the maintenance service for the estate. If it is actually linked to a very strong developer, the developer does not hurt its interest, but it actually helps to give them projects to work on. And because of the position that they have also started to branch out into the projects of other developers that have fallen. So the cash there is accumulating and generating. Is a good sector to go as well.
Yeah. Well, the next is a macro question on China's, again, deflation pressure. Do you think that China is experiencing the same deflation as Japan 30 years ago? And in fact, my view is that we are slowly walking out of that. If you look at the August or July CPI, China is actually visible recovery. Again, neither Florian and I are really macro expert. Do you have any thoughts on that? China's deflation risk?
Yeah. I mean, while we are bottom-up stock pickers and we invest very much bottom-up, of course we need to respect the macro and we need to risk manage with the macro. We spend a great deal of time trying to understand what's going on. I mean, I think that the comparisons to Japan are, I think, a little misplaced because the starting points are very different, right? So when Japan went into this deflationary spiral, Japan was at a point where Japan was something like 40% of the global stock market capitalization, where, you know, famously the Imperial Palace in Tokyo footprint was worth more than the entire state of California, and where all of Japan was certainly worth multiples that compared to the entire US in terms of real estate value. So Japan was truly an overvaluation of both the stock and property markets. China obviously had a hiccup in its property market and a real crisis, but that's the government itself managing down an emerging bubble. That's why we are where we are, because the Chinese government intervened and didn't let the property market develop into a Japan-style property market. And as we all know, the Chinese stock market is sadly nowhere near 40% of global stock market capitalization. So we are in a very, very different starting point. We actually don't have the excessive asset bubble that necessitated a deflationary spiral. So different starting point, different pathway, and therefore we think it's not the right template to look at China through the Japan lens.
Yeah, and even if, you know, China faces deflation, there's a connection here also. I see that even though China may not enter a Japan-style deflation, but China does have deflationary pressure. What this means is that China will continue to cut rates. And now US is also cutting rates. We have high certainty that US is going to cut rate in September. Just think about what we just talked about in terms of the high dividend yield or yield strategy. If the rates are getting lower, that's even better for a yield strategy. That's another reason, whether you invest in the US or China, you need to think about yield as one of your positions, because that will benefit clearly from whether it's China or US rate cuts. Okay, we talked a lot about China so far. Florian, I know you also invest outside of China. There's actually a question on India versus China. I get this question all the time, and I cannot think of a better person to answer this than you. So please go ahead to share your thoughts about what are the opportunities at India, how, you know, whether that's a better choice today than China in the current environment.
Well, I'm actually an overseas citizen of India, and my wife is originally from India, and I spent a lot of time in India, and we had over 20% of our strategy in India for the last 2-3 years, but we actually sold more than half of our Indian exposure at the beginning of this year, because valuations have reached our target price, and we're a very valuation sensitive investor. And as much as I enjoy going to India, and I actually agree with the great long-term thesis for India, the country, I think India has a lot going for it as a sort of macro investment theme, but I think a lot of the optimism is also a bit too excessive and misplaced. A lot of, especially foreign investors, they just invest in India because it's the other large Asian country and it's not called China. I mean, that's very often where the thesis ends.
Right.
And so there's a lot of laziness when it comes to underwriting Indian investment thesis. And so we find that investors are actually quite complacent, don't really understand what they own, and the valuations are very high. And we think there's a better opportunity in Hong Kong, China, especially the H shares right now. That's not a verdict on the future of India. We think the future of India could be a great one, and it has been already a great one. And India is certainly a nice sort of GDP success story. But as an equity investor, today's valuations in India don't set you up for great returns, whereas we think the H shares in Hong Kong set you up for very good returns, because all the bad news is in the price. And in India's case, all the good news is in the price.
Yes. What about Korea and other countries? We prepared this slide. I know if we have time, we can probably spend 5 minutes to talk about it. Outside of China, outside of India, what do you find the most interesting in Asia today?
Yeah, so the money that we took out of India, we invested in opportunities in Korea and Indonesia. Korea is now our second largest country, and there we really like the other place that's imitating Japan's ROE governance reform, which China Series, that's where it came from. They even stole some of the language from the E2 review in Japan. The other place in Asia that's imitating Japan is Korea. Korea as a country is basically giving itself the same treatment that Japan went through the last 10 years on the governance side. And there's now a website. I really encourage everyone to go on the Korean Stock Exchange website, where companies can officially submit an improvement plan of what they're going to do to get their share price up and how to get their return on equity up. So it's a document that addresses both strategic and capital measures of how to get ROE and stock price up. And Korea is building an index and an ETF that's going to then invest in these companies that are working on getting better. So that's exactly the Japanese playbook. And we think that's going to be a very interesting source of ideas. We have been actively working with some companies as an active owner here. And then I guess Indonesia is sort of a teaser. It's we think we've been increasing our exposure to our Indonesian ideas, mainly because Indonesia has really reached, in our view, sort of rock bottom on the valuation side. Foreigners have sold out of that market after the elections because of the very unusual long handover cycle. And so we think it's it's an interesting place to look and hunt for dividend yields right now. But yes, our strongest conviction regionally remains, much to the disappointment of many of our European and American friends, China.
Thank you. Thanks for that. Again, it's rare to hear that kind of view among foreign investors, and clearly you have done the work and understand what's going on in this part of the world. There was a question on whether you see any SOE, Chinese SOE in the artificial intelligence space or anything close to that.
In the strategy, we do own a company that's called China Communication Services, that is actually an implementer of higher tech programs. So they have done a lot of contracts around 5G and IoT implementations with companies. So as technologies mainstream into more sophisticated IT services contracts, this is a company that benefits from that. So naturally, our valuation sensitive approach doesn't lead us into, but that's just our analytical style. We don't like to pay a premium for the dream. We like to buy the substance at a discount. So this portfolio is less likely to chase the latest shiny thing. This portfolio is always more likely to chase what's a bit unloved. But in this case, we can actually have both. So China Communication Services is, at one point it was trading at negative enterprise value last year. But it's actually a sector leader in IT services implementation and paying us a nice dividend, net cash, and it's an incremental beneficiary of being sort of a partner of choice for companies and other SOEs when it comes to rollout of new technologies, IoT, and as of late, energy efficiency and AI.
Yeah. How about Australia? Do you invest in Australia?
We do go into Australia from time to time, but again, it's more about finding the right ideas. Currently,
It's bottom up again.
Yes.
Yeah. As a natural result of your stock screening, your fundamental research, and stuff like that.
Yeah. We had a nice winner in Australia last year that benefited from the sort of dislocation in the global new car market because of the delay of the chips. But yeah, currently we have one very small holding that's a residual from a position we've been exiting, but no directors, not much of a direct Australian exposure right now.
Yeah. Okay, there are a few remaining questions not closely related to what we talk about, but let me do a quick sweep of that on the US dollar Japanese trend. I don't have a strong currency view. If you worry about the carry trade again, I don't think you should worry. The Japanese central bank already came out saying they're going to be very careful about any rate movements, conscious of these type of black swan events in global markets. It's really tough to put a number on how big this trade is. Some people say it's just a few billion left. Some people say it could be 20 trillion or maybe even higher, because this weak Japanese yen is not going on just for 1 or 2 years, but going on for a decade at least. So we have no idea how much is accumulated in the channel in terms of taking this negative view on Japanese yen and a positive view on the US dollar. So not much of transparency on how big the carry trade is, but given the coordinations among the central banks around the world, I think the risk is significantly reduced. And again, if we think about things like artificial intelligence or even today's high dividend yield strategy, In China, I don't think this Japanese yen is the issue. Remember, on August the 5th, the China market was the best performing market while everyone else crashed. So that's probably another reason that to add that diversification into a portfolio. Okay, the next question is a very generic question on how to pick the right Hong Kong stocks. I think there's some missing words here, as a busy professional or something like that. I think to rely on a professional manager to manage your money will be good. And it's critical to find the style of the manager that match your investment objective and your risk profile, right? Today, we are talking about Santa Lucia Asset Management, which is a value-driven, dividend-paying, strong cash. It's a cash-generating product.
We tend to look at the companies delivering the results, but at the same time, what we also ask of the company is that they don't pay us 100% of all their earnings. The best sweet spot to pay us is probably 30, 40, or maximum 50%.
Yep.
But the other 50%, they need to invest into the business, generate that growth, so that there's a next leg for the price upwards, that we can then make the capital gains out from.
But general, it's a more value-driven strategy. What I try to say is, it is a good strategy, but it may not be the only strategy. Actually, then leads to my next question. So, in terms of relying on professional manager like you to manage the money, investor naturally need to think about what style or what profile they're getting to. And yours, to me, it's a very solid and steady kind of income generating, and based on company fundamentals, cash generation, et cetera. Now, to me, it seems to me the opposite of that is kind of a growth style. When you do let's say, a global technology fund, which some people may also like, right? Very little income, very high risk, but also very high return. So it's really up to investor to kind of pick and choose where you want to be, or you can have both. Our suggestion is actually you should have both. Whether stock picking or fund picking, you need to have a stable part of the portfolio that is relatively resilient and can weather through the economic cycles. On the other hand, you can participate in these high risk, high reward situations. But I guess my question to you is, when an investor invests in your strategy, will they necessarily lose that growth potential?
Well,
you're contrarian. You tend to invest in these type of, I would say, slower growth, right?
They're not slower growth. The reason why we got into this positions is because we recognize that the market didn't like them, and we are getting in at a good value, good price. But does it mean that the company is X growth or no growth? No, it doesn't mean that. And like we were saying, they just by paying us the 30-40% earnings is enough for us to get paid 6 to 7% yield while we're waiting for the change, for the investments to happen. So we're not missing out on growth. We are just investing with a value style for the returns, a total return that we're looking out for. In fact, if we compare ourselves to the index, we have been delivering something like 14% CAGR for the last 24 years. And that, on top of that CAGR, 6% of it actually comes from a targeted 6% yield, and the rest of it actually came from capital growth. So we're not missing out on that. Would you like to add anything?
Actually, we're running out of time, so let's try to end this sometime. I want to first of all thank you, the two guest speakers, for a very excellent discussion on investment, especially investing in China, which everybody's interested in. Logistically, this session will be recorded, will be made available on the UOB Kay Hian website if you want to listen to the replay. We apologize, we cannot answer all of the questions today. There's a lot of good questions, including geopolitical questions. We will try to follow up as much as possible. And you guys are based in Singapore, so if you're in Singapore, you can contact your sales representative to get your company's contact information. Next week, Florian will also be in Hong Kong, and we try to put together a small group dinner with limited guests. Again, because the nature of your company and your product, it's professional investors only. So if you're interested in meeting Florian in person, we are having a small group dinner next Tuesday, the venue to be determined, and please RSVP to Iris Lee in Hong Kong. I want to thank again for everyone to dialing in and for a great session.